And forgive me for putting words in your mouth, Reeve, because you never explained why you would miss this trade. You just said it was because of the other elements. I'm assuming the other elements, by other elements, you're talking about the outside markets. And you can see from the outside markets that we have an oil price that's been rallying through that process. And obviously, if the oil price is rallying, it's very difficult to be a buyer of oil at higher prices. That's one thing. So that's absolutely certain. Take a look at equities. Equities had been doing very, very good for the sell trade at the top edge, but they had started to just roll back out of that trade again, didn't they? So there's a question mark about the equity story, but it certainly doesn't look as if it's a great trade for long bonds. And it certainly doesn't look as if it's a great trade right now, but as I said earlier to the guys in the room, there is a QE feeling about this. When we look at the other storylines, of course, we can look at inflation break-evens. We can look at the J's. Let's take a look at the J's, for example. We can see the J's had been diverging and had been dropping quite hard when I was buying buying bonds here. So again, you can see that the J's agreed with Reeve. So Reeve's 100% right in what he says, but he still missed a very, very big $1,000 trade. Now, what's the problem with that, missing that trade? There's one serious problem that missing a trade like that causes. And it's not about Reeve, it's just about anybody that's trading and they miss out on a big move. There's a big problem with that because people start trying to call tops to try and prove that they were correct. Understand? Michael probably have seen this many times in trading over the last few decades as well. When somebody misses a move, there is an annoyance with a lot of them that they've missed the move, and therefore they've missed the move. They were right all along. It wasn't a trade in the first place, and therefore they try and fade a trade that should never be faded. So what happens is if you miss the buy trade because you think it's a sell with the value that's coming in, the mind tries to make you work into that as a sell trade. Do you understand? I am not wrong. I know it's a sell trade, and for that reason, you guys that are buying, I'll show you, and they start selling in here. And they get busted, and they sell in here, and they get busted, and they sell in here, and they get busted, and they sell in here, and they get busted, and they sell in here, and they get busted, and they sell in here. And by then, they've lost their account. Proving that they were right all along. You don't have to prove anything to anybody. You've made a decision, and you live by that decision. You don't have to prove anything to me or anybody else. Reeve didn't like the trade. He never took it. He doesn't have to prove it. He doesn't have to prove why he didn't like it. He just understands himself. It's not about anybody in the room. It's not about me. It's about, he has to understand himself that things change. The market changes literally from minute to minute. And because the market changes from minute to minute, well, Jack, I mean, it's a throwaway comment, but it's a very serious comment because I've been guilty of it myself in the past. I've seen a market that I think is a sell, and I've sold into it, and I've ended up getting a scratch trade, and I still like the sell, but the price starts moving against me, and I refuse to look at it from that buyer's perspective. I refuse to take a two-way look at it from both sides. It's like any political debate. It's like any debate about anything. There's no debate unless you're willing to look at and listen to the other side of the debate, to listen to and look at the other side of the argument. So when you start seeing a market that's got all the characteristics of a sell and you sell into and it doesn't work for you, if the value starts going against you, just don't try and get your own back on the market, because you're not going to win those battles, guys. You're going to come out horribly last on every single occasion. So my hope for Reeve is that when he's missed the move, that he doesn't try and get even. He doesn't try and sell into those higher prints. He doesn't try and do that. He simply goes back to the charts and says, right, what did I miss perhaps on this trade? What did I miss on this trade? Why have I not seen what was developing there on the front end of the curve? Because that's what got me into the long trade, plus the comments I made earlier to Paul, who did hear me, that I felt that it looked like a QE type day today. It felt like, and it looked like a QE day, and I was saying that there's a very good chance that we'll end up buying oil, buying bonds, and buying equities. That's what I said this morning there, Paul, wasn't it? Because that's what we did. We bought oil and we bought bonds this morning at 8 o'clock. I was long oil and long bonds this morning. Isn't that interesting? So the next question that we've got from the bond trader's point of view is, what's the most important driver of bonds? Interest rates, the Japanese yen, oil prices, or equity prices? Where would you position those in a hierarchy of driving qualities? Interest rates. So it's the most important. So whatever the short-term guys are doing on the curve is the most important piece of information we can bring into the charts, because these guys trade interest rates. We trade inflation at the back end. The front end guys trade interest rates. It's all called fixed income, but it is a very, very clearly different. It's a different desk in the banks altogether. The short-term interest rate guys sit at one bank of desks, and the long-term inflation guys sit in another bank of desks. Completely different desks, completely different setups. So when we look at these as stories, we've obviously covered this morning because I felt like it might be relevant this morning as we go into the kind of a little bond class this afternoon. I wanted to look at this to make sure everybody wasn't missing out on this, and it was a really good class to do this morning because that was the reason why I managed to get the bond on play. So when we look at that reason, this was the chart we were talking about here. Does anybody not see the buys on that chart? Does anybody not see the buy trades on that chart? Now, I had this on a 5-minute chart, so it's not lining up particularly well, but you know, once we start lining it up, we can start to recognize the buy trade opportunities. Is there anybody that would not have been able to see that? If I said to you, right, the trade is that you're going to be selling the blue line and buying the orange, is there anybody that doesn't agree with that trade? Is there anybody that doesn't agree that you'd be selling the blue line and buying the orange in terms of a spread? Is that one of the biggest spreads we've seen in a while? Just look to the left. It is a significant size of spread setting up here, isn't it? It's a very, very significant spread setup. Very significant. So therefore, I'm a big buyer of treasuries in these areas, a big buyer of treasuries. Now, it flattens out here at 1330, but it goes back into that same buy trade here. If I take you along to this point here, for example, if I take you along to this point here, for example, and if I take you along to this point here, for example, there is very, very definitely a divergence creeping back into this at that point. So at that point, I'm back on the long bond. So there's long bonds all the way through, and then a possible profit take in here, and then long bonds again in these pullback trades here. So when I look at these are all long bond opportunities. Every one of these is a possible long bond. If we understand that, and we look at bonds, you'll see that every single one of these upright lines is a long bond. Buy trade here, 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 and then pop big style to the upside. We're being able to forecast what the guys on the short-term interest rate desks are going to do next. And because we're able to forecast what the short-term desks are going to be doing, they're going to be obviously steepening, not steepening the bond, but steepening the back end probably will be an outcome. They'll be flattening that trade. That means very, very simply that we'll be expecting to see this bond price going straight north. Straight north. And that's what we're trying to figure out from that classroom we did this morning. And obviously, if you'd gone through that exercise with me this morning, you've been able to find that trade very, very easily, because that's obvious what we should be doing. We should be buying lots of treasuries. And if you go back all the way backwards, you'll see that this spread is just unbelievable. It's never really gone into a blue buy trade, has it? And it was a sell up here on the blue line here. It was a sell on the blue line here. It's never really done anything but be short blue, long bonds. Short blue is lower rates Lower rates means higher bond prices, yeah? So if we've got lower rates, we've got higher bond prices. Well, did the blue ever overtake? Well, there was a couple of times it kind of dropped down, spiked, gave us profit takes, possible sells. You can see obviously in the background there's one here, right at the very, very bottom edge here. There was a little spike here that you could have taken for an exit walkaway, which is exactly what I did. I used that for my exit trade there. And you can see that there's a little bit of a story starting to evolve again, but I'm aware of the fact that the full curve is rallying behind us just now, so I'm a little bit concerned with that. So not really for me just yet. Not just yet. I want to see this 210s balancing out a little bit before I start doing anything. Trying to sell this, which would be a buy on bonds, interestingly enough. So I'm going to be waiting to see if I can start getting into this at a slightly better price. If I can flatten this out a little bit and I can get a little spike on the blue line, I can make some money by buying some treasuries to retest back into the highs again. So, if you agree with me that the whole day has been dominated by buying bonds, which you probably must on the basis of what we've just been discussing, if you agree with me that the whole day is dominated by buying bonds, and then we get rid of all of these elements and we buy bonds the whole day, you'll be able to recognize if I buy bonds the whole day, the bond has explosively made a fortune on the upside. Is that not huge? Is that not a huge outcome? Damn right it's a huge outcome, guys. We bought bonds at 198.10s. It's traded 227s this morning. 200.27. So we've made over $2,500 profit. $2,500 profit, guys, on a buy side treasury from 8 o'clock this morning. And that's on a straight line swing. We've been in and out several times. So this has been one of the biggest days we've had for a while on treasuries. It's been a very, very, very big profitable day, guys. We'll cover this obviously in Classroom. We want to talk about the short-term interest rate, boys, in Classroom today. Did anybody get the spike on gold on the short? Big spike on gold, swept the top edge stops. Before the real yield started to fall, you managed to get a short bond trade off of 32, short gold trade off of 32s, dropped down to around about 28s, 27s. $400-500, Paul, $400-500 on the trade. Yep, I can't see anything else, but that was the trade that certainly stood out. So here's the trades. Gold's been a funny old character today to make money on. We've seen short-term values coming and going, and the one that stands out is this top edge because it is a top edge. It's quite easy to spot it, plus the huge surge in volume would have probably grabbed your attention somewhat. And you can see, obviously, with real yields starting to rise a little bit with the euro dollar weaker with a stronger dollar, selling the top edge of gold is a delight for a change. Selling the top edge of gold here is a delight. Now, the only downside for you was that by the time you got to the bracket lows, what happened? The euro dollar had risen, the real yield had started to fall, and you never really had much of a choice. You had to close off your short trade for 500. On the basis that you've now closed off your short trade, you would now be looking below here for possible buy trade, yes? And when it never happens, you've got a choice. Do you start crossing in? Do you start crossing in? Did anybody cross into the gold longs? Paul says he's gone for the long squeeze, so I'm assuming Paul's one of them. So you must have taken the squeeze for the break higher here, which is what you should be doing. But you've got to be aggressive to do that. You've got to know what you're doing to take these trades in a buy trade. And if you don't know what you're doing, then it's you could end up paying horrible, horrible, horrible retail prices and getting jammed. So the best thing to do in those situations is look for your dealers buying on the book. Look for the delta buying on the book. Look for the withdrawal of liquidity. Make sure the dealers are pulling offers. And if the dealers are pulling offers, you are green lighted, Paul. Green lighted to stay long and run with the trend. If the dealers aren't pulling their offers, forget about it. Also in today's classroom, I want to try and get you guys to start thinking about trading blind on the crack spreads. A class we did a while ago. A lot of people liked it. Some people actually used it to become oil traders. I know Sam and Cliff utilized this short-term approach to trading oil. I don't know if Sam and Cliff are in this morning. I see Cliff's name, but I haven't seen him typing in today. But I don't think Sam's in this morning. But certainly, Sam and Cliff utilized this to some degree or another. Whether they still utilize it or not, I'm not sure. But for a scalper, it's a brilliant trade. It doesn't mean the market's going to turn. It doesn't mean the market's going to turn, but it does mean that you've got a big edge. And it's a very, very simple edge. It just shows us that prices are overcooked. It shows us that prices are overcooked. So when I see a big volume, and what we're trying to do with this exercise is, this is not a price chart, guys. This has got nothing to do with prices. Well, it does obviously have something to do with prices, but it's got more to do with understanding relative value. So when we look at relative value, we can start to recognize what a relative value means, what relative value looks like and it feels like. The difference between acceleration and deceleration is very, very important. So when I look for these, if I look at every single one of these areas where I see a big acceleration of something or a deceleration of something, I mean this big volume here, for example, the purple line is accelerating to the downside, but so is the orange line. So what's the trade? I don't know. So if I don't know what the trade is, it's not a trade, right? It's probably an exit. Somebody is exiting some oil at that price. If I was going to be doing anything, of course, I'd be selling oil. So it's not like I don't have a trade outcome. I do have a trade outcome. I could sell oil if I wanted to, if the values were different, if the divergence was there. As it transpires, the correlations had started to work for me, and I did actually take a little bit of short oil off the 50s. It dropped down to 35s, and I made 15 ticks. And I've got to stop at break even just now. So it looks as if I might end up getting scratched out in this because the value is not in this chart. The value is on another chart. It's the euro dollar. So when I see this, it should start to make sense about what I should be doing. If the purple line is above the orange line and I get a big, huge surge of volume, if the purple line accelerates higher far, far, far quicker than the orange line, I should be buying lots of oil. In this situation here, the purple line was accelerating faster than the orange line to the downside, which is why the purple line is leading the orange lower. I should have been able to make money scalping oil shorts. I just did. I just took 15 ticks out of that trade. But it's not a great trade because you'd have to be judging the background more in that trade than anything else. So I am a seller. If the orange line is behind the purple line, I'm a seller of oil at higher prices. That's the way it works. If the purple line is above oil, the orange line during this phase, I'm a buyer of oil at bottom edges. And that was from 13.25 onwards. I was a buyer of oil. And sure enough, that was a bottom edge of oil. It was 81.90s to 82.40s. It was a good looking bit of trade. So this is a trade in its own right. This is a trade in its own right. And obviously when we look at this trade, this is a trading screen. This itself is a trading screen. It doesn't even show price on it, guys. That's what's incredible about this. As I was explaining to the guys this morning, and for the guys that haven't seen this exercise that we did live in the classroom years ago, we do this exercise. We still do this exercise, but this exercise started years ago with the interns. And it was to teach the interns that you don't need to see a price chart to make money. Now, obviously, we're taking a bit of a gamble that they make money doing this, which obviously always pays off. It's never not paid off so long as we don't take one trade in isolation. But what we're trying to do is we're trying to get them to understand relative value and volume. Because obviously the idea of volume becomes important because this looks terrible. It just looks like two lines. It doesn't give me any real confidence that things are in play. But if I add volume to this chart, all of a sudden, the activity by the institutions in these areas where the value is very obvious allows me to now make an incredibly high probability trade decision. Not just a high percentage probability, guys. These trade decisions are worth about 90 to 95% success rate. That's how good they are on the time frame that you choose. This is a 1 minute chart. So obviously a very, very fast kind of a price action chart, this one. We can do it on a 5 minute chart, we can do it on a 15, we can do it on a 30. But on when you understand it, if you understand that this is a buy trade here, because the purple line is accelerating away from the orange line massively, and the volume is huge, I know this is a buy trade. I know there's also huge volume in it, but I know it's a buy trade, 100%. So if I look at my my oil charts, that buy trade there is this bottom edge. It's actually the bottom tick price of today's business at an RGL, no less. And obviously that gives me this very, very high degree of confidence that I've just found the bottom edge of oil. And guess what? I did. I found the bottom edge of oil. And I was able to pick up the long oil away from those levels. And you can see that the same trade happened into this trade here. You can see that we got the deceleration on the purple and acceleration to the upside on the orange. That's a sell trade. You can see if that's a buy trade with purple over orange, this must be a sell trade when purple's below orange. Now I like to see the move on the purple line. The move was actually on the orange line, so there's a concern about this one, but it's still a sell trade. I am going to be able to get my stops into the break even in that one. And that was a sell trade, and it didn't reverse the market because it was the orange line that was moving, not the purple, so I'm not that keen on it. But it still didn't lose money. It still made some cash to the downside. Not a lot, but I never lost any money. And that's what was important about these edges. You don't lose money. We'll cover this in classroom this afternoon with the STRS traders, just so you guys understand what I'm talking about.